So here we go. This is my target price for Nvidia. This is what I think the stock should be selling for. It's based on 3 different valuation methodologies. First off, we have the discounted cash flow. Second, we have a price to sales valuation. Then we have an EV to EBITDA valuation. So what do I think this stock should be selling for? Keep watching to find out. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. What's up everyone? My name's Robbie. This is Robbie Neal, and today we're doing a stock analysis on Nvidia. Real quick before we start, I do have some affiliate links below. Take a look at those. One of them is for Barron's newspaper. It's my favorite investing newspaper. I'm honestly kind of sad that I don't get it over here in the Philippines. I like to read the actual physical paper, but I can't get it. And you can though if you want to take a look at the link below. There's also the digital copy if you prefer that. And also, thank you very much. RG Laredo, you left a comment to do a stock analysis on Nvidia. So that is what I'm doing today. Really appreciate you leaving a comment. Thank you so much for that. Jumping right into it, this is what I have for Nvidia's price target based on price to sales. So I have a $137 price target. This constitutes a negative 18% rate of return. This is, let's say if this would happen, let's say in the next 12 months, right? So that's my price target. So let's call it until 2023. Then 2026, this time period, 26, let's say, $257 price target, 9% rate of return. So a little bit less than I would want to see over that time period. I would, of course, like to see it, especially right now where stocks are probably pretty cheap. I would like to see it higher, at least, let's say, 12%. So a little low on the price of sales, but of course, we have some other methodologies coming up. So let's just go quickly over what I got here. As per usual, I was pretty conservative here. So what I did was I assumed they're diluting you a little bit on forecasted shares. So this is step 1, find the outstanding shares. So I'm assuming they're going to be diluting you just like by 0.40% every year. Step 2, I'm going to forecast the sales. So I'm using backward looking numbers here. And basically what I see is the different time periods over 1 year, 3, 5, 9, median return here and the average return of these returns. So I'm starting off with a 30% rate of return, and then I'm actually decelerating it over time as this company gets bigger. And also, by the way, semis are pretty cyclical companies, so I definitely would assume that sometime over the next few years, this company will end up having some headwinds and some growth will be stalled a bit. So I don't expect a linear line of growth. So basically 30, 25, 20, 15, 10% growth, and that brings me to step 3. I'm picking a price to sales multiple in the future and also, let's say, at the end of 12 months. So basically what I got here is these historic price to sales ratios at the end of the different years here. The average is 15.93, the median is 15.99, 15.93 is the current. So 15s are pretty close to what you might expect. But of course, like I said, cyclical company, I don't know how, as this company grows more, price to sales ratio of 15 is going to be pretty high. So I'm going to go with more of a conservative, let's say Google-esque type price to sales with a 10. That gives me a 137 price target. So that's a negative 17.65% return. It grows over time. It gets up to about a 9% rate of return annually. Now, if you think it's going to be a little bit of a higher multiple, you could take a look at the 15 here. That's going to give you a 23% rate of return. And it's going to probably give you a decent rate of return over that time period. But again, I'm being more conservative, and I'm not comfortable going with a 15 price to sales multiple in 2026. I think it's high. Okay, so moving on, let's go over the EV to EBITDA valuation. What I have here is 2022. We have $146 per share. That's negative 12%. 2026 price target, $278. That's 11% rate of return. So getting closer there. So that's actually better than the price to sales. Let's see what I have. Same thing on step 1, I have shares decreasing by 0.40%, increasing, diluting you by 0.40%. I have EBITDA growth in step 2 where I forecast the EBITDA growth. These are the different growths, of course, really high growth for the past year. And actually over the past multiple years, it's been very high EBITDA growth. Median's been about 40%, average has been 52% growth rate, so very high growth rate in EBITDA. You might be asking why am I going to be using lower numbers and then decelerating it so much? Well, I think the EBITDA growth probably is not going to continue again. Cyclical company, potential headwinds at some point in time. Maybe there's a recession coming soon, I don't know, but if it does, I don't think semis are going to be the best place to have money. So I do think that growth is going to slow a bit at some point in time, so I'm decelerating it to be conservative, 30% all the way down to 12% 2026. This leads me to step 3. I got the EV to EBITDA multiple, so I have the historic EV to EBITDAs on the different years here, and this is what I have. The average is about 42, the median's 41. Of course, company continues growing. I'm not going to expect this company to have that high of an EV to EBITDA multiple. So what I'm going with here is I'm saying let's go with a 25. I mean, I would say at this time period, this company is big enough that having a 25 EV to EBITDA multiple is probably going to be pretty high. But it's got really good margins. Company is growing well right now. I'm going to just say what happens if that happens. So that's 146 price target. For now, that's a negative 12% return. That gives us, by 2026, $278 stock price, about almost 11% rate of return. Let's go over my Cat 5 score real quick. So basically, I made this score up. These are the things I like to see in a company, or at least I like to understand what's going on. Most of these are based on the industry that it operates in. So I compare this company to its industry. I use deciles. So essentially that's what I do. And basically what you have here is a 62% Cat 5 score. I like it to be 70% or higher. The only place that this company really didn't shine is the valuation. Let's look real quick and see why that is. So basically for PE ratio, for example, it's a 43.42 PE ratio right now. It's high compared to its industry. Now you might be saying, well, profitability is really high. It's in the best decile in terms of the industry. You can see here, gross margin, 64%, net margin, 37%. So maybe it's justified, and it's growing, right? So maybe this is justified, but it's the most expensive or the highest PEs, one of the highest PEs inside the whole industry that operates. I don't like seeing that. So I don't give it any points, right? Same with the forward PE with the 24, with the price to sales with the 15, the price to free cash flow with the 55. So these are high to me. Anyway, besides that, if you're comfortable with that, maybe you don't care. I do care. I think the valuation's a little bit expensive, a little rich for my blood. Okay, let's think about free cash flow. So what do I have for this company? What's the value of this company based on free cash flow? So for this one, free cash flow has grown tremendously for this company, about 40% over the past 5 years in compound annual growth rate, free cash flow. Very nice. So what I'm doing here is I'm not going to be giving it a 40% free cash flow growth. Again, cyclical company. I think there might be issues where there's going to be some free cash flow, let's say, not decline, but it's just going to, let's say, not grow as much. And so that's going to average out. What I'm going to go with is an average out of 20% free cash flow growth, which is a tremendous free cash flow growth rate. So I'm giving them that. This gives me a $121 price target if I use a free cash flow growth rate of 20. So we come back over here to my weighted average, and what I do is I say, well, free cash flow is probably a bit more important than EV to EBITDA and price to sales multiples. So I'm weighting it a little higher. I'm giving it 50% of the weighting. $121 price target is what we had there. Price to sales valuation, 25%. So 137 was there. 25% is then also the weighting is on EV to EBITDA, 146. Brings us a total weighted average. This is what I think the target price of the stock should be, of $131. This is an upside of negative 21%. So I would want to see the stock come down further from here. Now, some things to note. Earnings are coming up for this company. They are coming up in about 2 days after I'm recording this. So we'll see what happens with earnings. But let's real quick see what happened with or what's going on recently with some other semis. So right now I'm looking at AMD, another semiconductor company, and I just want to show you what happened with earnings for AMD. Earnings were released back in May 3rd. AMD had an earnings surprise, reported $1.13 of earnings per share versus an estimated 91 cents, so a nice surprise in earnings. It also reported higher than estimated revenues at $5.8 billion versus $5 billion, so it did a good job on its earnings call. And so if we take a look since the time where this earnings came out, we could see how much this stock was up. Let's just draw it from here. And currently the stock's up about 4.6% since then. So Good earnings, up 4.6% over the next, 2 weeks from that point. It did get as high as going up right after earnings of about 10%, got all the way up to about 15% up. So you don't know what's going to happen, of course, if Nvidia does beat. Maybe Nvidia also has a similar type of return. So of course, Nvidia has performed well over the past year. So basically, we're going back here. I'm going to draw this from about March of 21. This has gone up. It got up as high as, let's say, it closed back in November at about 100. What is that? 188% was the growth of that over that time. So of course, a crazy growth over that time. Maybe that was a little bit much. Maybe it's a little rich, So since then, what's happened? Well, if we go back, draw a line to where it is today. So basically now it's down about 50% from that time period. So probably a little bit overvalued at that time, and now it's come back closer to probably what it should be valued. So the company broke down through its uptrend channel and has not gone back into it. That was back in April of this year. And now it's down, sitting in the, let's say, 160 area. It's getting close to the parallel line of the downtrend line, and so we'll see if it kind of touches this area. But it's getting a bit oversold down here. We do have RSI showing at about 38, so pretty much neutral on RSI. MACD is pretty far down there. The oscillators are green, so that's good, but they're not that big. So we have a very close oscillator right here. So I'm not seeing a lot of momentum, let's say, in the oscillators. I don't see any divergences between MACD, RSI, and the price. So essentially, this to me is like, let's see what happens after earnings, and basically the economy's not doing well. Semis probably. I don't think I'm very bullish on the general industry if there is some type of real recession. So for those who might be concerned with the recession, this I think might be a bit of a stock that won't perform as well. But that's just my 2 cents. Of course, I think this is a really amazing company. I think it's, of course, got amazing margins, gross margins, net margins. Profit is doing well. It's growing at great clip. So a great company, don't get me wrong, and I think there's a long runway for what it does and what it operates in. I just don't think necessarily that right now I want to buy it at this price. So basically, I would essentially wait until this comes down further to my target price, and then if it did, I would definitely be in for this stuff. Just an FYI, I did buy AMD because it is closer to my valuation, so I do think AMD is within like an area where it should be selling for price-wise, and this I just don't. So anyway, that's all I have for this video. Thanks so much for watching. Hope you liked it. If you did, hit the thumbs up, subscribe to see future videos like this one, and please watch another one of my videos coming up on the end screen right now.